morning, everybody. This is Fred Meissner with the first post-midterm election conference call, November 4th, 2010. Let's get right into it. It's going to a little bit more things than others to comment on. First of all, let's talk about the stock market for a minute. We have been expecting a pullback after the election, and so far the market seems to be actually going the other direction. Our benchmark for changing our opinion is 2 closes above 120 on the SPY, which is equating to around, say, 1,200 on the S&P 500. Let me make one thing clear that I know is probably clear, but just for new subscribers. That is, we are intermediate term bullish on the market. We think that after a relatively mild pullback, 5 to 9%, we could have a very strong up move next year. The third year of a presidential term is traditionally the strongest. We do think gridlock is good. Our only concern here is the indicator configuration. It would be ideal to see the indicators pull back a little bit to set up a really good rally. That certainly doesn't have to happen. I have seen the market rally from indicator configurations like this. That is true. I will just note, every time I've seen a false breakout in the market, it has been from an indicator configuration like this. So I think the correct way to trade this is, if you're an investor and you're not so worried about buying at the end of a pullback, I'd be putting money in this market right now. And I'd be thinking to myself, golly, if it does pull back after I buy it, I'm going to add money. In other words, I don't see any reason to throw all your money in or go in on margin. I do see plenty of good stocks to buy. I refer everyone to the sector report and to the strong stocks in the best sectors, and we'll take a look at a couple of sectors here today. Also, international is looking good. I've got no problems with the market, but realize this could be a false breakout. We could have a whipsaw. The market could suddenly come down and then turn around and exceed these highs. So with that, we'll sort of go into some sectors here. And by the way, looking at the intermediate term charts on the mid-cap index, mid-caps are still outperforming. We like the looks of the MDY in here as an investment. We like the looks of some of the Russell 2000 stocks. The IWM is above 72 right now. Staying above 72 would be very, very important to that ETF, which is the Russell 2000. We think that can be an outperformer long term. In terms of sectors, an area I'm looking at very carefully to upgrade is the XLB materials. Materials are looking much better than industrials right now and are still trading extremely well. We note that discretionary, although it's now an equal weight for us, looks pretty good. Some of the stocks in there are particularly attractive, particularly retailers. We'll talk about a couple of those when we get to the stock section of the call. And healthcare is drifting up. The only real bugaboo negative, and these stocks could have some oversold rallies, is some of the banks and, of course, the XLF don't look nearly healing. So, you know, we like the market across the board. We are prepared for a pullback. We've been waiting for one. 2 closes above SPY 120 would tend to make it look like we're not going to have that pullback. As an intermediate-term trader, I would add money. As a short-term trader, if we get those 2 closes over 120, we'll probably start to add some trading stocks and ETFs to our list. Taking a look at the bonds, I was little bit surprised at the huge outside day negative reversal at resistance that we had on the TLT. But that said, the TLT pulled back into the 99 area, which is only $3 from the 96 area we've been looking at. I would not be short these bonds. I'd be looking more now, and am looking more now, to see if we can get a buy signal on them somewhere between here and 96. If the TLT pulls down to 96, you will still be in an uptrend, and that will be support. For people who have to put money into the bond market right away for clients, we note that corporate bonds continue to look better, and we'd be doing those. For people that are looking for speculation, the HYG has now broken firmly above 90, which is the resistance area we've been using, currently trading in the 91 area. That says to me that credit fears are abating, and the high-yield bonds are probably going to do much better in the next year, and possibly than regular bonds. Note that that index has even been up, the HYG, while the TLT has come down. I think it's a measure of risk, and that's saying that things are much better off here than they were. Let's talk a little bit about commodities. It has not escaped my notice that we had a very big open on gold today, and gold is currently up $28 and right near all-time highs. We continue to like gold intermediate term. It's our favorite market overall. We are believers in inflation. We have an 18th-month target on the GLD of 152, which corresponds to roughly $1,500, $1,520 an ounce in 18 months. With this kind of gap, obviously, you got to be a little bit circumspect as a trader here. But if this gap holds, we have an island reversal on gold, and in our favor, the daily chart did pull down into the 27 area on the stochastics, which is fairly low risk. If I were an investor, I'd definitely have a position in gold even at those levels. If I were a trader, I probably wouldn't be buying it right here. To be honest with you, I'd be sort of sitting, seeing what we do here. Silver is also up. We like silver a little bit less than gold, but the metals in general look good, as do commodities. We featured the DBC in our midweek report. That has held the 24 area support, is now rallying up towards 26, and looks like to me commodities could stage a breakout here. Oil, which has been trading non-seasonally, is above 37 on the USO right now. Should the USO have two closes over 37, it's probably going to head to 40. And we, again, like oil in the winter, we're just thinking it may sort of shilly-shally around a little bit for the remainder of the fall. And it has not traded seasonally all year. It wouldn't surprise us to see this actually go up. Turning to the currencies, the dollar has had a little bit of a sort of pattern on it. Frankly, currencies have a tendency to trend more than any other investment that we monitor, and the trend on the euro is up and the trend on the dollar is down. That said, though, we still could see the possibility, as long as the DXY holds 76, of a dollar rally, but that's looking a little less likely. And what that means, by the way, for stocks, with the yen up a little bit but below its highs, stocks like Coca-Cola and McDonald's that have international exposure and are in consumer areas are probably going to do much better than stocks that just have domestic exposure. With that, I think I pretty much covered all of the markets. We're going to go into some of the Asian ETFs and then stocks.